A call to order the King George County Service Authority Board of Directors Budget Work Session. The first thing up is public comment. Do you have anybody in the audience who would like to speak? All right. We will go now to our appointments of our Citizen Budget Advisory Committee members. Mr. Morris, did you?
So,
How do you want to do this?
Madam Chair, so I've informed Ms. Cupper here tonight. Basically, you need a formal vote to appoint
Okay.
your advisory committee members. She has their names, and that is just an official action we need to take here tonight.
So, yeah, I do have a motion. I move that the King George County Service Authority Board of Directors appoint Mr. Jim Lynch and Ms. Kim Dodge to the Citizen Budget Advisory Committee.
Got a second?
Second.
Any discussion? All those in favor?
Aye.
Any nay? Chair votes aye. Congratulations. Thank you for joining us. Mr. Weekly, the General Manager, Service Authority status.
Thank you very much, Madam Chair. Again, welcome, Ms. Dodge and Mr. Lynch. We appreciate you willing to serve on this. And I just want to say before I get into my overview, the purpose of tonight's meeting is I know some of you all are new to the Service Authority Board of Directors, so there are some baselines we wanted to cover here tonight. We have some financial overview that report we'll be presenting tonight. We also have our audit, which is required. We also want to have that presentation tonight. So kind of the format, what I'm thinking is Mr. Grossnickel from Robinson Palmer Cox will come up first. We have a lot of handouts versus visual aid, however we do, and I thank the sheriff and his team for allowing us to have the venue too, sir. But we'll have some baseline information. So when we move into the budget items, the budget meetings in the future, you'll have some of that baseline. Some of you were not here when we did debt restructuring, for example, a line of credit, and you'll get to see with the model recalibrated, what does that look like, where we may have fell short for the year, and where we're going for the future. So that's the purpose for tonight. For my status update, some of this information was in the handout I gave you all in our one-on-ones, so it's just an overview. Yes, we own and operate 5 wastewater treatment plants. We have 9 well systems, and we maintain 35 pump stations. Currently, and what we have in our audit, so those numbers have gone up because we've reached 50 connections this year already. But in the audit, which you'll see, there are 4,239 water connections. We have 2,498 sewer connections. Not all of our customers are full service customers. Some are water only, some are sewer only. This gives you a count of both. We currently have $30 million in debt service. I'm sure Mr. Moore will speak tonight and give you an update on that. But we have many needs to update, repair, and replace in our infrastructure. This list is one similarly that I presented to DEQ in November 15th. But you can see item 1, pump station upgrades. We have over $1 million worth of that. We've had that set up with DEQ. But we're going to do that in 3 different phases. We have item 2, Perkins Corner wastewater treatment plant upgrade. This board will be decided in the future. Do you want to do that treatment plant? Do you want to decommission it and reroute it? That's an estimated $10 to $14 million. That was a range provided by Wiley & Wilson, but that is not based on an actual putting it out for bids price. That's just an estimate. Item 3 would be decommissioning and rerouting Oakland Park. That has a price tag of around $4 million.
Weekly,
Yes, sir.
I hate to quibble, but I think that's more like 5 million. Isn't it?
I believe 5 was the rerouting for Perkins Corner.
I thought the total was 9.7.
Yeah, I remember that too.
Perkins Corner was 4.6, which leaves 5.1. I mean, I know we're only arguing over $1 million.
No. I have over 4, but I'll go back
But I
and
think it's closer to 5.
I'll go back and
Yeah, I
refine
remember
that, sir, and provide an update on it. I just have it over as 4, but I will get that.
But I just want to follow up real quickly, because the $4.6 million figure is what we use to reroute Perkins Corner as recently as Tuesday night before the Planning Commission.
Okay. I will update these numbers, sir, if they're off, and fine tune those and send those back out to the board. I apologize if those numbers were off.
All right, well, while I'm interrupting you, one more thing.
Yes, sir.
The $30 million in debt service, that's principal and interest?
That's principal and interest, yes, sir. Good question.
No, that's principal.
That should be principal and interest.
Mr. Worley, if he were here, he would make sure we all understand that the principal is, I thought more like 25 million. It was always Trying to correct the 3-line star.
Yeah, it's both. It's both. It's principal and interest, that number I gave you.
Okay.
But Mr. Moore, please capture that when you get to your presentation, as well as Andrew pointing out the audit. But they have it, Davenport has recalibrated that model, and that'll be shared with you here tonight.
Principal was about 23.7 million in 2009.
All right, thank you.
Yes, sir. Continuing on that list, there is earmarked the need of a new sludge handling facility, whether that would go to Perkins or Hop Yard. It was estimated $2 million. Nine's well system overhaul, $200,000 to $300,000. We have the remaining well system repairs. A lot of those we would try to tackle in this year's budget. That's estimated around $150,000. And then potential water line system interconnections. Those are all planning. Any kind of system interconnection, we do not have that forecast right now. That was part of a utility master plan that outlined some areas that they thought would make sense to interconnect. Moving down, FY 2021 projects, so this will be items we are looking to tackle in this upcoming budget, and we will definitely get into those items in future sessions, but just to give you a placeholder to be thinking of, we will tackle item 1 here, pump station priority 1 items. They mainly consist of 3 existing generators we will repurpose and locate at 3 wastewater treatment plants. And that will be roughly 28 pump stations we need to purchase and install along monitoring systems. As you see at the top, we have 35 pump stations. We have started installing some of those alarm systems now, so we're not waiting to FY 2021. Item 2, Nine's well system overhaul will happen in calendar 2020, so it would happen this year. We do have prices back on that. We're trying to work through some of the staggering figures. Item 3, again, this board would have to make a decision on the future of Perkins Corner, whether you're going to decommission and reroute or build a new wastewater treatment facility. What I have currently in earmarking in the budget is mainly engineering costs for FY 20 budget, assuming that the board of directors wants to move forward with the new treatment plant. So those are some projects we would be looking to tackle in FY 20 and 21. Madam Chair, that's all I have for my service board status update.
Just to make a little bit last week that you talked a little bit about the status of us getting all of our DEQ actions. I forget the terminology exactly, but all of those cleared up. And if I remember, you told us that they were all pretty much cleared up, but there was a couple more to do. Am I remembering that right?
Yes, sir. Yes, sir.
Are those captured on the list?
Basically, yes, and I say basically yes. We have 2 items that are outstanding. Consent order items is what Mr. Lynch is referring to. So we had a whole laundry list of items. Yes, sir. Yes, sir. That DEQ and the Service Authority negotiate on and finalize. We had those down to O&M manual submittals, which will due at the end of this month. And we believe that'll be finally satisfied. And that leaves remaining pump station upgrades to meet the reliability Class 1 standard. What the Service Authority Board of Directors and DEQ has been working on, I say within the last year, is the understanding that we want to close out all those items except for the pump station. We recognize that cannot be done in 1 year or less. Those items need to be staggered out. There's many reasons, construction, drawings, financial side of it. But they are looking to close out, or I guess they would call it amend the current consent order, where they will pull everything out that's been closed and they'll leave that 1 remaining item. So the other treatment plants that the pump station are not attributed to, they would close those out and those plants will no longer be under consent.
Okay. So it's okay with DEQ if we stretch out the upgrades to the pump station?
Yes, sir. Yes, sir. We submitted to them a plan. It's basically a 5-year plan. Priority 1, we would do within, and I should have had that in front of me, we would do that in 1 year. And the other 2, priority 2 and priority 3, we would do that over up to 24 months for the next. So priority 2 up to 24 months, priority 3 up to 24 months. So that gets us to that 5-year mark. But we also put in there that if we can tackle items earlier, we would do so. We wouldn't try to stretch it out 5 years. So some of it's a planning phase. If we choose, if the board of directors selects to own certain facilities and we have to upgrade, some of those are going to require construction documents. So you'd have to go out for engineering and drawings for that.
Madam Chair, can I just follow up on the pump station? Mr. Lynch, the consent order with DEQ had sort of a broad category of tell us about your pump stations and where they fit in terms of regulatory requirements. And we didn't know. So we had to hire Wiley Wilson to go out and look at all 35 of them and come back. So that was not really a part of the original consent order other than that generalized way. So we've gotten everything else in the consent order basically done, especially all the things that cost money. But because we didn't know the status of those pump stations at the time we negotiated that consent order, summer 2018. This particular issue with pump stations is going to drag on a lot further. I know DEQ doesn't like to have the consent order open that long, but the issue was in there in a general way, so we would rather just close everything else out. We have to stay on the consent line. But this will take some money to do it.
Okay.
Madam Chair, can I ask one other question
Yes.
on Mr. Weekly's thing, his presentation? How much of a priority, Mr. Weekly, is a new sludge handling facility?
I think we need to start planning on it in the near future, at least in the next couple of years. It's not just the logistics of windshield time. I just want to give a visual to everyone. So our only solids handling facility, that's where you're pressing the sludge. It's located at Dow. So think about where that's located. And all of our other facilities, that sludge that needs to be processed through that machinery has to be transported via truck, our own pump truck that we have, down to that facility. So there's not only the logistics of it and the windshield time, that's not why I would say, hey, let's go out and do that. But it's also trying to process that amount of value. Sometimes we get a little backlog in our solids inventory and we get rid of it because we're trying to either A, haul it to the site, or B, keep up with the sludge production down at that facility. If you only have one of those items that sees a lot of operation, just like the pump truck itself, you begin to think of it like miles. You begin to put a lot of miles, a lot of hours on that equipment. So that's a crucial piece of equipment. If you lose that, it has to be fixed. You hope you can get that up and running in a few days. But also, as you increase customers, you're going to increase some sludge production. So it would help us out with those two benefits to be able to keep up and running. Also, there's an aspect that I haven't mentioned yet. Septic handling. Right now, septic haulers in King George County, those monies they're leaving the county. They're not staying in the county, sir. We would like for those monies to stay in this county, not allow that to go to the Little Falls treatment plant in Stafford County. So there's other benefits for it. If you're going to have the equipment, at least get some revenue. Now, I want to be clear, that's, we're not going to generate $250,000 or $500,000. We may generate 20 to 30, maybe up to 40 a year. That's still good money to put back into at least maintenance or some little bit of debt service towards it. But it is a critical item that I think that should get tagged in the CIP at some point. But that is also laid out, I believe it was in the feasibility study that was recommended, that we would locate and actually go ahead and build another solids handling facility.
This might be before your time, but do you remember DEQ pushing for that as well? Do you recall that?
I don't know if I've seen that in writing. I know our inspector, who's been onto our site many times, they understand it because what was in our consent order, they talked about freeboard. And that was the amount of level you had of solids and all built up in your tanks. And one of the things when they put that out there, we literally had to write a document that said, how are we going to handle our solids? So one of those things was putting together more of an accurate schedule, determining how much had to be pumped from each facility. So one, we're keeping on the task. We're not just pulling a little bit here and there. We've got to be scheduled. But two, to be able to analyze, is it realistic to process all the solids we have at that location? What does it take the time? So they didn't say build it, but they were concerned about the freeboard that we had, the levels in our tanks of solids.
Any questions?
Okay, so moving on, so the way we have this structured here tonight, and you all reserve the right to change it anyway, is you have about a 30-minute or less presentation from each of the gentlemen here tonight. That would be with our audit and our financial overview. And we should be able to allow for about 20 to 30 minutes or longer if the board seems fit of Q&A, or if you want to interrupt them during the presentation. But that's what it kind of had structured here tonight. Again, it is required by law, but we appreciate Andrew, Mr. Grossnickel being here tonight with Robinson and Farmer Cox. Robinson and Farmer Cox, I don't know how long they've been our auditor, but they've been here a long time, do a phenomenal job. They also do the county's audit. There's a lot of information in here. We don't expect you to be able to digest it here all tonight. But any questions, ask them here tonight. Any future questions, just jot them down. We'll get the answers for you. Mr. Grossnickel?
Maybe I'll just kind of do my presentation from here, because that
Okay.
podium's quite a long ways
Wheel it
away.
over to you.
Oh yeah, that'd be great. I just feel like I'd be over there on an island. So I have a few handouts. I apologize. I have a PowerPoint handout. In transitioning between sick kid duty between my wife and I failed to grab the USB device that had this on it. And hopefully I don't have any germs I'm passing out here. So far, my wife and I have been immune to it, but both our kids have been taking turns.
How old are your kids?
8 and 4.
Oh, man, fine age for drugs.
Yeah. Our house is about the cleanest it's been in a year. All the cleaning we've been doing to try to keep the contamination. No, I don't think I'm plenty loud. So I'm gonna try to kind of walk through the presentation slides here that I have as a handout, and then, kind of also be referenced in a few pages within the financial statements that are passed out, and hopefully we can make our way through pretty well.
Andrew, do you have an extra? The gentleman out there, CT, would like to have a name.
Right there. You can give it to us.
Steve, can you get him the agenda too, please, sir? They're on the back page.
So I appreciate your time this evening, and General Manager had asked that maybe it would be appropriate to come to a work session where there's a little bit more free time to ask any questions, especially with a couple new folks on the authority, and a lot of things coming up with with debt issuances and capital projects of that nature. So I'm just going to kind of go through the results of the audit process, give a few financial highlights. Talk a little bit about the uniqueness of the authority compared to the county from a financial reporting standpoint, and then I'd be happy to answer any questions that you have. So on the handouts here, one of the first things that we have a couple of pages in is an engagement summary, and really this just kind of lays out what we've been engaged to do for the Service Authority, which is a financial statement audit. That's the primary focus of our audit procedures on the financial statements, and then also some compliance that's required for governmental organizations. And we conduct our audit, in accordance with different standards that are required for governmental auditing. Those being the auditing standards generally accepted in the United States of America, specifications for audits of authorities, boards, and commissions, which is put out by the Auditor of Public Accounts for Virginia. And then also the standards for financial audits contained in the government auditing standards, which is issued by the Comptroller General of the United States. So, on the next page, you'll see kind of a little summary of our audit and attestation results. And really the main byproduct of our audit procedures, everything we do, while we do assist as part of our preparing the financial statements, the main byproduct is our opinions that are included in the financial statements. And for the Service Authority, there are two such opinions that are included in the financial statements that are our auditor reports or opinions. The first one is the independent auditor's report, and that's really on the numbers in the bound document. That's going to be located right after the financial section tab, starting on page 1, going all the way over to page 3, and that report is really on the numbers in the financial statements themselves. And the Service Authority received a technical language as an unmodified opinion, in layman's terms, a clean opinion on the financial statements. everything in the opinion we have here is just normal disclosure that we have to make in our opinion, kind of accounting legalese. The only thing a little different this year than in some years, although it's been frequent that there's been new accounting pronouncements, but there is a highlight there in the opinion that there was a new accounting pronouncements that went into effect in 2019. And they have, at times, moving forward with what you're going to be doing, they will have the pronouncement that went into effect has a little bit of effect on the service authority, because one of those accounting pronouncements that went into effect related to the capitalization of interest on enterprise type capital projects. So in the past, if you were spending a significant amount of money on a enterprise or water and sewer capital project, in addition to the actual physical costs, you would capitalize a portion of that interest that was included in that project. And moving forward, they're sort of stopping that treatment, and that's going to be expensed just as regular interest expense and not added to the capital project. But the other report that is contained in these financial statements is at the very back of the financial statements and right after the compliance section tab. And that is what folks commonly refer to as the Yellow Book report or the Government Auditing Standards report. And really that is for governmental organizations. A lot of non-governmental organizations that may receive significant government funding from federal and state sources have to have what's called the Yellow Book audit or Government Auditing Standards audit. And in that report, we would address any significant deficiencies or material weaknesses in internal controls that might come to our attention. And we didn't have any significant deficiencies or material weaknesses that came to our attention during the course of our audit process. We did, however, and this was the other handout that I passed out that was kind of a little memorandum looking piece of paper. We had one management letter recommendation for improvement in internal controls. And our recommendation related to the accounts receivable reconciliation process. Oftentimes with the receivables that are posted from the billing registers, there are then edits to the billing registers and different things like that. And we have recommended that a formalized monthly reconciliation process be developed to reconcile the billing registers to the accounts receivable ledger to ensure that the billings and the edits and all of those items are properly reflected in those general ledger receivable balances. And it's kind of worked out that it wasn't intended this way on our end, but it worked out that it was good timing because the service authority is about to go to a different sort of computer system for the receivable module. And so the timing of implementing, some of these new processes and enhanced processes, while at the same time bringing online that new module from like an accounting ledger standpoint, makes a lot of sense. So we've discussed that with management, and that's going to be something that's implemented in conjunction with that, and we're also available to kind of help with that as they work through that, and help confirm that what they put in place is going to be something that's going to work well. The next kind of item on my handouts here was related to some 2019 financial statement highlights, and so I just wanted to kind of touch on. I'm not going to get too deep into the numbers, but I do want to touch on some of the highlights for 2019 year end. The first being on page number, for those of you following along in the financials, on page number 11, Exhibit 1, we have what's basically the balance sheet for the service authority for a governmental entity that's full accrual, meaning having all of your capital assets and long-term debt. That's referred to as statement of net position. And so the service authority, whereas those of you that work with the county, there's the modified accrual basis where we have fund balances, and then there's also the full accrual where we have net position. For an enterprise fund, which an enterprise fund is basically any fund that is designed to sort of have user fees that make it self-sufficient or try to attain supporting that enterprise, they are only on the full accrual or business type basis, because they're trying to show it in the way that a business would. And so they have all of your assets and liabilities are on your balance sheet or statement of net position. And for 2019, the total net position was $19.5 million compared to $19.7 million June 30, 2018. That was a decrease in that position of just $200,931, which is shown there on the following page on Exhibit 2. And the operating income for the year was $321,120. So that's just taking your operating revenues and operating expenses. It does not include interest expense and then the other non-operating items such as capital contributions, which this year you did have a couple of capital contributions. Kind of flipping back to the handout here, I have a 5-year analysis of the change in net position. So you can see from 2015 to 2019, a little bit of the trend analysis for the overall change in that position. That outlier there with 2015, there were some significant developer contributions in that year that were down in that capital contributions line of $1.9 million that really drove up the overall increase in the net position. And then you can see kind of, the next few years there's been a decrease in that position, 18 and 19 relatively small decreases in that position, from $180,990 in 2018 to $200,931. And in this exhibit here, or this kind of trend analysis that I have, in the operating expenses, that does include depreciation, which is very, not a cash, item for the service authority, but a significant expense. So for 2019, for example, out of that $5.6 million of operating expenses, $1.5 million of that was depreciation. So again, not a cash item. And again, it's one of the things you're talking about budgets tonight, but that's one of the elements that makes enterprise fund a little bit different from a budgetary basis. To budget for the depreciation, you budget for principal expenses, but they don't show up in the expenses here, because of the budgetary nature of, how we're on a full accrual. There are cash outflow type expenses that you kind of want to account for in your budget, and internally throughout the year, you're going to see how you're doing with that. But at the end of the year, those principal payments are going to go to reduce the balance sheet account rather than to show up in your expenses. And depreciation is one where you're not having cash go out the door. It's not like anybody's got to tell finance to cut a check, but it is a true and a significant expenditure, operating expense for the organization. In the non-operating items, that is primarily interest expense that's making up that. You see that about $1 million every year there over those 5 years. The next I have just a little kind of a chart line graph that goes over 5 years of operating revenues and expenses. And you can see that kind of, for the most part there, the operating revenues are just staying right there above operating expenses from an operating profit standpoint. Both trending up a little bit the last couple of years, but in both regards. Getting back into the financial statements for just a moment, I do want to highlight a couple of other items. Yes, sir?
If I remember last year, you talked to us when you were explaining all the net position numbers and how they were changing. And I wonder if you could reverse for us why that's important. Because I remember last year that you seemed to be an important thing for us to have like double that business position.
That might have been Davenport.
Yes, sir. It would be Mr. Davenport. So when they come up, part of that area, they're going to speak about debt service ratio. And that position is key.
That's right.
Yes, sir. Davenport will get that. Yes, sir.
Yeah, so kind of, we're kind of mainly just kind of confirming that these numbers are accurate. Then Davenport is kind of interpreting it more and what that means, and then what areas you might want to look at, making changes to from a rate standpoint, all those kind of things to be in compliance with different things with debt and help you more with your capital planning and long-range planning and things like that. So it probably was Kyle, who does look a little bit like me.
Well, thank you.
Yeah, no problem. In the financial statements, page number 13, just to kind of reiterate a little bit again about the difference between kind of the accrual accounting and your cash flow standpoint. On page number 13, Exhibit 3, we have a statement, cash flows, which takes the, those accrual figures and it then backs them down to a real cash inflow and outflow, cash equivalents, cash and cash equivalents, and how much in total cash you really have at the end of the year compared to the year before. So there's certain things that, through the year-end close process by the staff and through the audit process with any potential proposed adjustments that relate to assets and liabilities, the non-cash assets and liabilities, really change kind of the net, the change in net position from what a cash basis would be for things like payables. If you have more payables at year-end, than you had the year before, then that really means you kind of have a little bit more cash at year-end because you haven't made those payments yet, although they're bringing down your net income. So, this really takes you back to the simplistic thing. A lot of people like to say, well, how much cash do we have, and how did that change? So, at 2019 year-end, there was $3.2 million cash, which was a decrease of $352,101 from the year prior. The year before that, cash went from $3.77 million to $3.5 million, which was a decrease of $250,000. The majority of the middle of the report, I'm not going to get too deep into, but those are the note disclosures. I will highlight, one area that obviously is something that is always important and something you're going to touch on a little bit tonight, I think, too, is page number 23. Where we have the long-term obligations note, and that goes through, and we have kind of comparatively 2019 and 2018 changes in all of your long-term obligations. And these tables not only show your hard debt, such as your revenue bonds and things of that nature, but they also have your other liabilities that are considered long-term liabilities, such as compensated absences, OPEB, which is other post-employment benefit, liability, and net pension liability, which for the authority, those are relatively small. And then you can see there the amount due within 1 year, and as you go through the next few pages, you can see the required amounts to amortize each of those categories of long-term debt over the next 20 years or so, principal and interest for each of the items. And then you can also see, moving forward to say page 26 and 27, each of the individual debt issuances listed out with their terms, the total amount outstanding, as well as the amount due within 1 year. There was, as a subsequent event, there had been some debt that's issued, subsequent to June 30th, 2019, and the very last note that's in the note disclosures points out that, subsequent to year-end, there were some obligations. Those obviously don't show up in the 2019 figures because they were issued after June 30th. One last thing, two last things that I will point out briefly. There's a tab in the financial statements called statistical section, and that goes through several stat tables that include information such as the number of connections that the general manager alluded to, and some of other data on debt service, on revenues, expenditures, even non-financial things such as the miles of lines and things like that, and gives you a trend of all that information over 10 years. And so that's some good information to kind of to look over to get a trend analysis of where the authorities trended over the last 10 years. And then finally, moving backwards just for one moment, and finishing probably where we could have started, right after the opinion on page number 5 is what's called a management discussion analysis. And for those of you that may be new to the authority or haven't heard me present at one of the board meetings, a lot of times I like to point this one out because oftentimes when we're looking through these financial statements, they have gotten quite long and they have a lot of information and disclosures about OPEB and different things that that really can sometimes muddy the waters. And the management discussion and analysis is a narrative document that kind of encapsulates the financial highlights for the year in just a few pages of narrative that you can kind of read in conjunction with going through. So if somebody was to say, if I could only have a few minutes to kind of review the financial statements and get a good feel for it, it would be to kind of go through the management discussion and analysis. So those were really, the kind of highlights that I wanted to touch, our opinions and, recommendations we had for improvement and some of the financial highlights. But at this time, I'd be glad to open it up to any questions you may have.
Are there any problems that you noticed that we wouldn't have to read the whole document?
No, again, that was kind of where I was staring at the first, the opinion. The opinions are clean, they're good opinions. We didn't have any material weaknesses, and we did have, the one thing we had was that internal control recommendation. And again, while we're not primarily focused on the internal control aspect, government auditing standards, require us to, as we go through our audit process, to evaluate controls as they lead to, areas that could cause misstatements in the financial statements. And one of them, which, we had again as a management letter comment, is just adding some strengthened controls around those receivables, because if they were, if they do, get out of control, they're not, reconciled as well as they could be, that could lead to a, financial statement mistake. We're not saying there is one here, and in fact, we're saying the contrary, but we're saying that that's a control that can be strengthened to ensure that nothing gets off the track.
Go ahead. I know you're saying about the cash flow versus the accrual. So when I look at that, the cash flow one, that's not the actual accounting statement because you have done it on an accrual basis.
So it is one of the financial statements, but all organizations, they primarily have a balance sheet, whatever it's called, and private businesses call it a balance sheet. Governmental accounting, it's a statement of net position. It could be a statement of members' equity, something like that. And you have either a profit and loss statement for a small business. You have as we call it here, statement of revenues, expenses, and changes in fund balance. Those two exhibits, Exhibit 1 and 2, are on a full accrual basis. That means that all liabilities, whether they've been paid or not at year end, are booked. All assets, receivables, and things like that are booked. But the statement of cash flows on Exhibit 3, it has a thing here at the very sort of the bottom half of it. What it does is it takes the operating income of $321,120 that's on the previous page on the accrual basis, and it backs that down to the net cash provided by operating activities, which then goes up to the top and leads you down to the true change in cash. Again, it's really just in any kind of industry, they like to look at cash flow, even though the financial statements are on an accrual basis, because they understand that some of those things, are not, they want to make sure that there's cash flow readily available for different operations, things of that nature. So they have that in here. And throughout the year, I know historically a lot of times, and finance directors here, service authority, county, other localities have often kind of prepared some things for the service authority that may be more of a cash flow analysis throughout the year, because that's really from a planning standpoint. Again, that's more of the cash payments that are going out the bank, those kind of things, and is valuable, especially like in a budgetary process, because these year-end expenses aren't going to line up as well to what your budgetary process is. Again, because you had about $1.4 million of principal payments on debt. Those are cash flow expenses that you're accounting for, but on Exhibit 2, those will not show up in your expenses because they show up as a reduction of a liability instead of as an expense.
Yes, I don't know if this would be where I'd ask this question, but was there any, I'm looking at page 5, where there's a net position decrease of $200,000. says the decrease in that position is mainly attributable to operating expenses increasing at a greater rate than operating revenue. But yet they, last year they collected an increase in revenue. So I would warn like the budget committee, that's kind of a concern because my understanding is that they collected more money last year. I'm looking at page 5, right? But their expenses were greatly increased, and I know that's gonna keep happening because we have infrastructure, decommissioning and all that. So is that, I don't know if that's what you do here, you just look at the audit, but that would be a concern for me, that, looking at the budget. Then all of a sudden, there was a big, they collected more revenue, but there was also a decrease because of operating expenses.
You're worried that expenses are increasing quicker than revenue.
Right.
That's what you're concerned.
But I mean,
Yeah, no, absolutely, it's a good point, because I was gonna hit on at least a couple of things on that. So that is one you should be looking at right there, because you can't survive that way, and that would affect that service coverage, which we're gonna get into here in a little bit. We did anticipate towards, last year that there was concern of expenditures. We knew there were a lot of things that had to be fixed and immediate because DEQ were basically right there, fix this. So there was a cost of it. My job is to make sure we control that, stay within. So if you're also reading into that last bullet point on there was an increase. There was just some offset to the revenue. So if you go back, another important page to speak to that. So one, before I leave page 5, we have to make sure that the expenditures may be going up, but they're controlled within the budget that you all approve it each year. But if you also turn to page 62 in the statistical section, that's where you can track each fiscal year ended, where we were at on operating revenues, the breakdown within those revenues. You can look at operating expenses, the breakdown within that. So you can see years from 2010 moving to 2019. And you can see that some revenues were down and expenditures were definitely up. So it's a very good point. As we go through and we manage, so one of the things you'll see Ms. Dodge and the rest of the board of directors and Mr. Lynch is that we'll have breakout line by line sheets from our next budget session. And you also will look at historical trends. Because yes, just like the pump station work I mentioned earlier, that's a 5-year plan. We can't go after and fix that in year 1. Financially, that's not sustainable. So it's a very good key point that you pointed out.
Yeah, I think, and that's kind of getting a little into Davenport's area, but I think there were some things in 2019 that were putting out some fires, some emergency repairs and things like that.
About $80,000.
Whereas moving forward, the majority of the things they're going to be doing are more true capital in nature, so they're going to be capitalized and they're not going to, affect the operating revenues versus operating expenses as much as these kind of quick repair, projects to put a fire out. And so, that is one of the factors I think attributed to the outpacing. So again, you're correct, the revenues increased, the expenses increased, and expenses increased at a little bit higher rate. There was still an operating profit before interest, but it is a trend.
We do have, if I may interject real quick, looking at the recent cash flow report, I'll go ahead and share that with y'all this week. But we are sitting there's a $200,000 favorable delta right now between operating expenses and operating revenue year to date. So just letting you know that we're trending and also that cash flow, so you can see that.
So last year there was $80,000 in DEQ.
There was around 80-some-thousand this week.
The other thing, just for some context, the year ending, you guys have looked at that, June 30th, 2019. That budget year, we basically had 3 general managers, at least for some portion of the time. And we had putting fires out as one window. It's crazy. Could be considered a lot worse than that. But we had our interim general manager come in, they put all the fires out very nicely. And I'm not trying to be critical of them, but I'm not sure they had a handle on what our budget was. And we're as concerned about where we were in terms of our spending as they were in terms of putting out fires. So by the time Mr. Weekly comes on board, it's basically the end of November of 2018, I believe. And we're halfway through the budget year, and we've already spent all this money. And so that's I'm not in any way demeaning what you've done here tonight or what you're looking at, but this particular fiscal year, in some ways, doesn't tell us much about the service authority. Next year, what you tell us, I think, will be a far more valuable bit of information for how we're operating and what we're doing. We'll be after our rate increase, after our restructuring of the debt, and once we get a handle on all of those numbers, we'll see are we really going in the right direction or not. We did all those things after the time period where you cut off your review. Can I move on to one other question, just real quickly, Madam Chair? And I'm not sure that this is 100% appropriate for you, but on page 21, you've got the capital assets. And if I'm reading this correctly, our net capital assets are $40,214,000. Is that correct?
Yeah.
And is that the same as saying that's what all our stuff is worth?
No, on a governmental, and this is a common question, get a lot with economic development authorities and things like that. On governmental accounting, everything is at a cost basis for capital assets, unless it is property that is being held readily for resale, which is a little different situation. But these are historical costs net of depreciation. So the $40,214,000 is a net of what you've paid, over the years for your capital assets, and that includes, equipment as well as, infrastructure and everything, net of the depreciation. So, you take a useful life on each asset and depreciate it out. And so $40.2 million is not the fair market value of those assets. It is the carrying value, really, of those assets, the book value, which for a governmental entity is cost plus depreciation.
So in a way, it's the accounting value as opposed to the fair market value.
Yeah, you won't ever see fair market value of property like that, utility type property in a governmental accounting. That's just kind of one of the quirks of a governmental accounting, financial statements. That's a requirement that they have to be done like that. If you ever wanted, that would be something outside that you could have a study done to kind of get information on that.
We did that. Didn't they come in pretty close to this?
It's around 41.
And that's basically what our insurance coverage is as well, is that right?
Yes, sir.
Somewhere in that ballpark. So you guys are pretty close.
Well, that might mean in a government, a lot of times that might be more accurate, especially if it's not a lot. For you guys, for example, it's not heavy land. It's not heavy land involved, but even so, a lot of times I assume when they're doing that study, they're discounting that land not at its highest and best use when they're giving you the value. They're doing it at a little bit of a lower rate. So.
Okay, thank you.
Depreciation on equipment didn't change last year.
Depreciation on equipment.
This is page 24, halfway down.
Oh, that was not depreciation. That's the addition on equipment. There was infrastructure added, but not smaller dollar piece of equipment.
Oh, I'm sorry.
Depreciation below, there was $34,023 of depreciation on the equipment, 1.5 million depreciation on the infrastructure.
Okay. So we didn't add any equipment that would have depreciated last year?
Not from the equipment category,
Not from equipment.
based on the capitalization.
Thank you very much. And we'll have that Davenport.
Yes, Madam Chair, Mr. David Moore, and there's a couple things I appreciate about Mr. Moore. A rose.
Yes, that's all right, that's all right.
No, I got more on my mind, I apologize. He will give us more, but Mr. Rose, thank you, Dr. Young. So, two things, one, very knowledgeable individual, and two, we appreciate Mr. Rose coming tonight, because Kyle has the flu, and we all appreciate Kyle, but we do not want Kyle's flu. So as Mr. Rose is handing out the materials for the night, Davenport is not only the county's financial advisor, they are also the financial advisor for the Service Authority. They've been with us definitely this last year in the trenches of doing our financial modeling, debt restructuring, line of credit. A lot has gone on this past year. So I look for them to, they've captured a lot of that in the presentation here tonight. For those of you who were on the board last year, it's going to be an update from the June 2019 report. So you can always go back and compare if you want. The debt will be covered in here as well. So without further ado, Mr. Rose, I appreciate you coming down tonight, sir. The floor is yours.
Thank you.
And I apologize. Do we want a visual on this? If you're fine, that's fine. If you want me to put it up, I can put it up.
You guys will
Okay.
do the presentation.
Okay, good. Please, sir.
Thank you, Mr. Wiggly. Again, my name is David Rose, and Kyle has been my great colleague for about 16 years. So he's been about 25, I realize that, but he's been around for a long time. I've had the good fortune of working with the county going back when Elton James was county manager about 30 years ago. Way back, yeah, so I think this is my 40th year doing this, so appreciate it. I manage the practice at Davenport, so I appreciate that opportunity to do that. And like I said, Kyle's been terrific, and he was not feeling terrific tonight. So any real difficult questions, I may have to defer to them. And you mentioned Mr. Moore, that's actually Griffin Moore,
Yes.
who is one of our younger analyst associates in his 6th year. So we've been very fortunate. Just a little background on Davenport that I manage. We have about 500 folks. Started in 1863. It's now started the company, as you can tell. But through family, way back, it's been privately held since then. And we're out of Richmond, so I appreciate this opportunity. So what I'd like to do tonight is just walk you through some of these pages. Again, if I can't answer them, I'll let you know. I think there's a couple of things that might have been alluded to Mr. Grossman that perhaps I can answer or maybe try to get clarification. But again, as Mr. Young said, Dr. Young said, we are your advisor and only are thinking about what is in the best interest of both the county and the service authority. We are not interested in trying to provide you funding. We're not competing with banks. It's not our goal. Our goal is to be on the same side of the table at all times and to try to make sure that we continue to right the ship. And I think that's a nice way of saying it because we have seen where the authority has been. I was involved in the authority Bush Creek. So with that said, as you start moving towards the 21 fiscal year and developing an operating budget, setting water and sewer rates, we thought we'd provide a little bit of this as some context to hold that in the course of the next couple of months. In fiscal year 19, we've had a variety of regulatory required increases, both in operations and capital. I would agree with Mr. Bennett totally. When you have even one change of a manager, let alone 3 different changes. I think they're just trying to keep their head above water, and there's not really a sense of comparative to year before, year after. It's just getting things done. So I would not put much stock into the one particular year of changes of expenses, but what I would do is to pay a lot of attention to what I'm about to talk about in terms of the modeling that was set up. in some of the rate recommendations, things that you did implement, and we'll ask you to continue to implement based upon a certain capital program that's going to be highlighted here. So,
Can I interrupt you there real quick?
yes, sir.
We've set rates for the next 4 years. We've already set the rates. I just want everybody to be clear. We did that so that we could restructure our debt. We committed to that with BRA. And so that's sort of the default we're moving forward with that plan. If we wanted to change that, we'd probably be in default with BRA. Is that fair to say?
You would not be in default per se, but again, you would potentially put yourself financially into default. So de facto, you would be there because if the numbers don't show, again, what is required by VRA, and I'll talk about that, effectively the same thing. Yeah. So again, we always know, and this may be a little sobering, you can always change rates in subsequent years. Cities can do that, counties can do that. But yes, you did as part of your overall plan and your commitments to them, talk about setting those rates for effectively that 4 to 5 year period. So we want to show that to everyone that knows something. It's nothing new, but again, we're going to show you what it does, because I think someone asked, I think it was a little hard to hear back there, what it meant about maybe days cash on hand or debt service coverage. And that ties into that whole idea of having those rate increases to meet certain things to stay out of default. So
Mr. Bennett, I'll add some comment as well at the end that's directly related to some recent discussions with BRA as well. So quick question, and I'll catch up at the end of the presentation.
And so the other thing to point out here is the Virginia Resources Authority, talk VRA, that's sort of they have been around since about the mid-'80s. They are a state-run program, and water and sewer entities go through them. They provide excellent funding in terms of interest rates, because basically you effectively get to borrow at their interest rate, which is a combination of AAA, AA plus. So effectively you're borrowing at the lowest possible rate that's out there for a long-term rate. That's what it is. So, yes.
Madam Chairman, it's probably also worth noting that last year when we set the 5-year rates, it was not only a commitment to the VRA, but it was a commitment to the citizens of the county. We sold a high increase last year.
Yes.
Real high increase last year, on the basis that the out years wouldn't be as high.
That's correct. And you're going to see that. Nothing's changed.
It was 10, 6, 4, 4, 4, all of those highs.
And the other point to that, and I think let's go to page 2 if we could. That's a great segue into the top point here, and that is the service authority has been what we call self-supporting. You can see that note there. It's not reliant on the general fund. That's not always been the case, of course. Way back, it was very much reliant on the general fund. The fact that it's self-supporting, and that these rates continue to now keep it self-supporting, has multiple positive effects and impacts on not only those that are part of the service authority, but the county itself. What it does is it takes pressure off of the general fund in the county, which in turn allows the county to have better credit ratings. We'll see that. It also allows, again, the county to keep its tax rates as low as possible. And by doing all that, this is following what we call best practices, national best practices, both for the enterprise fund, which is again the Water and Sewer Authority, as well as for the county itself. So everything that we're doing here is in compliance and in accord with what would be best practices. Other point here is that we talked a little about how much debt you have outstanding. Again, it depends on the moment in time. So what your auditor shows at the end of 6/30/2019, you have roughly $23.7 million in principal. That number moves around a little bit in the fiscal year because different times in the year you pay certain principal off. So we basically, our description here say, you effectively have a little bit under 25 million of principal. And then, of course, you add the interest on that, and show you what that means to be the total payment. So think of it this way: if you were fortunate to have a home, and you have a home that you purchased at $100,000, just go through and say you bought all debt in your equity. That's why I should say that. That's the principal, and maybe over the course of 30 years, you have another $75,000 or $100,000 of interest. So we would say your total debt service is $175,000, but your principal is $100,000. That's the same here for the authority. Okay, we could go to page 3, and when we talk about county rating, again, the county has what's considered very strong ratings. When you got your first series of ratings, it was some 15 plus years ago, maybe longer. But since 2004, alone, the last basically decade, you've had 5 different upgrades. So you've gone from the A category, strong, that's all investment grade, to the AA category. And in one case, you're at the very high end of that AA category. The other 2 agencies, we call them agencies, you're right in the middle of that AA category. So you're solidly a very strong credit as a county. That's important. And by keeping the authorities separate and self-supported, that further helps the county stay strong, which in turn allows the county, when it does to borrow money away from the service authority, to borrow favorably and also to be, again, viewed very positively. So one thing that it also matters, not just numerically, but if and when the county looks to do, which it does, economic development, a lot of times businesses, both the ones that are thinking about expanding within the county or those that are not in the county, that are looking at a variety of local governments throughout, whether it's Virginia, North Carolina, or wherever, they turn around and look at what is the county's credit rating. If the county has these kinds of credit ratings, that says to a business that it more than likely can continue to fund its schools, to continue to do those things necessary to be on a very strong, sustainable track. So these ratings really have a myriad of important purposes. I don't want to belabor it, but I just want to make sure everyone, especially some of the new members or some of the folks in the audience, realize that. Okay, so on page 4, your 2020 fiscal year plan had several goals and objectives. And again, what we said was to make sure it was financially self-sustaining. We wanted to make sure that we understood and realized that there was going to be a need to right the ship, and that there was going to be a way to do rate increases, but to try to minimize them. And as one of the gentlemen said here, you still have a large upfront rate increase. We'll show you that in a moment, of course. But the goal was to not make it any bigger than necessary. And by doing that, we did some things that also recognize that you have capital needs over the next several years. And that's basically around 15 million of capital needs, again, for the authority. There's a way we talked about how we layered that in. That's that line of credit that Mr. Wheaton was talking about. So let's go to page 5. There was a series of strategies that were implemented. And again, one of those was to recognize that we needed to boost revenues. And so we did have, effectively, as we call it, a catch-up in FY 2020, the year we're now, by doing certain rate increase. We also took advantage of interest rates being at literally 40 to 50-year lows by doing some restructuring that allowed us to take away debt in the next several years as we start to raise rates, as we try to basically be in mode where we continue to right that ship. And we were able to do that and take the burden of the user rates to minimize that user burden. And you'll see that in a moment. In addition, we recognize that you have some capital needs I alluded to a moment ago, about 15 million. You'll see that in a moment. And what it is per year. And so we said, let's do that in the form of a line of credit rather than going to immediate, permanent interest and principal. We just basically pay for the debt as we draw it down. So we will minimize actual cash flow pressure on the authority over the next several years. And then finally adopting several policies to keep us, again, within the white lines, so to speak. So on page 6, this is on the right-hand side graphically what you look like in that brown line, if you would, your existing debt. We did not extend any of the debt. Rather, we moved it and got it, again, a little bit less in the next several years as we try to raise rates and we try to make sure we're not going to deplete fund balances. At the same time, we levelized it no higher than where it is and where it was in 2019, starting out in 2026. So we were able to do that as well. And by doing that, the interesting thing is we were able to take higher interest rate debt and exchange it for a little bit lower interest rate debt on average. So that's why we say we had a debt that was on average, we were paying 3.71%. Now we're paying a fixed rate of 3.15% on that debt. So we don't have any interest rate risk, if you would. We're set for that. And present value savings, we actually saved some money in doing all this. And that's not, we didn't necessarily go about, when we first started talking about this a year ago or so, with the idea of trying to save money all 20. We really wanted to get as close to break even as possible. It's just that rates were so favorable that we actually saved some money in a present value. That's a fancy way of saying it's like an APR with a car. Someone says, how much I pay, what's my rates? It's the all-in cost of money. The all-in cost of money on the debt, of which was a little under $16 million that we did, is actually costing less than it was a year ago.
The other thing we were able to do with the great assistance of Davenport is, I believe we were a week after the deadline for VRA, and we still managed to get in the door, which allowed us to start this 6 months earlier, which also obviously proved our advantage. We got the lower rates half a year earlier than we would have otherwise, so that's a big advantage.
We believe it a lot. Now, again, they are very good to work with. We also, not Kyle and I, but other parts of my firm, represent VRA, and they really understand that what we were doing made a lot of sense. And so I think they tried as a state entity to try to bend over backwards, and they did. So what happened was, this is the important thing, you can see where those green lines are. You can see on the right-hand side those savings. So we saved about $4 million plus from 2020 fiscal year to 2025, and then we ended up having a little more debt service in the subsequent years. And so all told, basically, it's basically a break even. We save a little bit net, because today's dollars are more valuable than future dollars. And that's how a present value calculation works. You gotta have a dollar today and a dollar 10 years from now. And that's really why the present values are the truth in lending type of thing. And we both save some dollars. But with all that was only part of the strategy, as I said. So go to page 7. The second part of the strategy was, again, recognizing that we've had some capital that we understand it. Again, we're not the ones that create your capital. We're not the ones that tell you when to borrow for it. Rather, we just absorb what is given to us by the staff that says, we think in these fiscal years, these are the relative dollars on before. We got that in the next couple of pages. So again, what we were thinking about was, could we set up a structure that was going to be favorable to you, but as things are very much volatile, we said, let's try to minimize it. So we went out and were successful in getting a multi-year line of credit that's fixed for 6 years at right there, we'll round off here, 2.4%. So no matter when we draw it down over the next several years, we pay 2.4%. Someone might say, well, what if rates go lower? You know what, if rates go lower, we'll be happy to talk about refinancing. But we think that kind of rate for 6 years, we were willing to recommend that you take that risk of 2.4, which is hard to get criticized, we think, in my experience over 40 years, over 4 years now, at 2.4%. I like that. So with that, the other thing is, third point, prepayment. We can repay this anytime without penalty. So that's why I say we really are in a very good position as we should decide. And lastly, the credit line has a security that's two parts. The first part, what we want, which you typically see for the water and sewer part, is we call it pledge of water and sewer revenues. It's very typical. And then a backstop of the county. It's not technically a legal backstop, it's a moral backstop. And that's important because your debt then doesn't count against Dr. Young's credit limitations. It does not. So the county stays flexible, but the benefit here is we get the benefit of the belief that if the authority should stumble, the county's there as a backstop. And that's the clear part of our obligation. So, page 8. I alluded to the 15 million. This is right out of effectively the Wiley and Wilson's rate report. And you can see there in a given year, it's going out through 2024, approximately what you might need. So it might be, and it is, seen it would be modest in 2019, fairly modest in 2020. So again, the way it's set up, you only would pay interest on the amounts which are. That begs the other question, if we don't draw all this down in the form of the next 4 or 5 years, is there a penalty to us? The answer is no, there's no penalty out there. They were good about understanding that a good faith effort that we would always use some or all of this. So just keep that in mind.
Madam Chair, if I can interrupt you a second. If I remember correctly, when we did this, that $15 million, the big ticket item was decommissioning Oakland Park and Perkins Corner. It wasn't building a new plant in Perkins. We haven't gotten that far, correct? So we were looking at, if I remember correctly, it was 9.7 million, so call it 10, to decommission the 2 older plants. So it's not, it doesn't necessarily take into consideration building a new plant in Perkins.
Make a note of that.
I mean, the money's there, we just can't use it for anything else.
Okay, so if I could, let's go to page 9. This page really has the whole essence of everything put together. And we've got a lot on the page, but I think, let me start by saying this. If you look to the right-hand side, you'll notice there that we've got increasing total revenues starting in 2019 out to 2028. And the important thing here is that that brown line, those total revenues, every year are in excess of the 2 green lines below. And there's actually one more with one line very also minimally able to see the transfer. But the point is this. What you have on the bottom, the dark green, is operating expenditures. That's an estimate of what we think, when I say we, working with the authority, it will be every year. You'll notice it's expected to rise every year, operating expenditures, because cost of chemicals, medical costs, other things are going to continue. Then we have the light green is the debt service. And the reason we restructured was because, again, we wanted to make sure that those total revenues in all those years stayed above the debt service and the operating expenditures. Because they don't. And what we have to do is draw down from your cash reserves. It's really that simple. So what we said was, could we all stomach, if you would, to make this work? And so if we look at now the table, increase in user revenues, as Brendan indicated, we basically did a 10% increase. And then the next 3 years, 4% thereafter, and then it goes to 3%. That is what is being committed to the Virginia Resource Department. Now, that will be reviewed every year because, you look right above it, it also presupposes that there'll be 50 new residential connections of equivalent thereof. No guarantee, I've been doing this a long time. That can drop down to 0, it can go higher. We have to do an average that basically the authority feels good about, the staff feels good about. Hopefully that's conservative enough, and again, that's not going to be problematic. Then you have the new borrowing, again, that layer that in, and that's based upon that previous page in terms of the line of credit. So what you see here is if you look at the end of 2019, it says ending cash balance in that green shade, 3.5 million, equivalent of 217 days cash on hand. And what it shows is that the revenue pledged to cover debt service is 1.76 times. Aggregate debt service, all of your debt is barely 1 times. So we set this up in such a way that we would have aggregate debt service at a minimum of 1.2 times. Really, 1.15 is the requirement of VOA, one little higher. And you notice here that our days cash on hand at the end of the 5 years is basically at 170. So we want it to be in a mode of roughly about half a year, about 180. That's the thinking here, is to try to recognize that with those rate increases, with the capital spending, with the expected residential connections, that we don't truly deplete the ending cash balance, and we always stay positive. So Kyle or I, you might want Kyle back, and blame if you did, we'll be back in a few months, or maybe every 6 months, or come back annually and say, well, what really did happen in 2020? What happened expense-wise, and what does Jonathan think the next 6 to 9 to 12 months look like on a variety of these factors? And as those things change, so too will our recommendations and our numbers. So, and that's how we work with many of your neighbors and have for years. So that's the way this is set up. Lastly, an interesting thing here, we'll put it up there. In your capital funding, that roughly 15 million, you'll notice that 11.6 is debt, 3 million is cash. We think that it's important that the utility authority, such as this, doesn't just go to the debt markets, doesn't just borrow 100%. So when I used that analogy earlier about having your house at $100,000, you want to have 80-20 or something like that. That's sort of what we're doing here as well. That's also important because if something really does bad happen, and we find that we need to use that cash and redivert that cash, let's say, and borrow more, use that cash to help towards debt service, you've got that flexibility, and that's why we've got that set up that way. So there's a method to that madness. So last page or two here.
Hey, before we go, let me just make sure. I had trouble with this last year. Let's still see if I got it right this year. So the information you're giving us on page 9 shows that our revenue is going to exceed our expenses, even with the $15 million being borrowed. Is that right?
That's correct. However, that's with the 15 million being borrowed over these next several years on the line of credit basis. We'll then have to kick in at that end time debt service when it comes to principal annuals. So we will continue to see where you are involved over the next 3 to 4 years as you then layer in the full principal interest on that 15 million.
On the 50 connections we agreed on here, I know some people thought that was a little high, but most of us decided that we were getting that from Hot Yard every year, and have for many, many years. we're expecting them to continue doing that for another 8 years or so at least. And that doesn't even include anyone else. So if we're looking at other development, and I know the county is, that could really help our situation too with connection fees in addition to those that we already assumed from the roughly 50 a year. We didn't assume any commercial connection fees because they vary in not only amount but in quantity. So that's sort of gravy added to all this as well.
That's exactly right. So again,
Can I get a clarification from Mr. Weekly? When you were explaining to me about some of these new commercials, you said everything is done in equivalent residential connection. So that one you showed me, I believe they came back as being 5.
Yes, I believe that's the recent, Eagles Nest Veterinarian.
Yeah.
Yes, sir.
So this 50 that you're talking about is strictly 50 residential.
Yes, sir.
You're not even factoring that 5.
We want to be conservative because in some ways it may balance out. So I don't want to get too far off Davenport's presentation. If you will mark page 65 of your audit, you can look at from 2010 to 2019, look under the column full service connections, water and sewer, and it'll show you where we've been since 2010 every year. So you can see there were up years, there were down years. The last 2 years have been strong. This year, we've hit 50 already.
Okay.
But as Mr. Bennett said, I mean, commercial, if we know it's out there, we can somewhat plan for it. It can somewhat vary. So we feel we'd rather be conservative with our numbers. If we go beyond that, great. It helps our cash on hand. It helps our number of operating days with cash on hand. But we wanted to pick a number where we weren't just, being too loosey-goosey, I guess to use for a term. But if you, again, look at page 65, you can see where we've been at. And we feel we have a pretty good, strong year ahead of us as well.
Mr. Wick,
Thank you.
sorry.
Thank you.
Mr. Wickley, do those numbers on page 65 include commercial connections as well?
Good
Yeah,
question.
Probably the full service.
We'll let's take a note. We'll come back and look at that.
For 2019.
Correct.
For the audit.
Correct.
Mr. Morris, do you have any other questions on that?
Thank you.
We're way over the 50 for the last 2 years, 79
Yes,
and
sir.
72, so 50 seems fairly conservative.
Yeah, I think we may have sold commercial, maybe not including the 5 ERC that Mr. Morris was referring to. I know we had like a Wendy's.
That was in 2019.
2019.
Yes.
So we've had a couple of commercial accounts, and we'll go back and look at that, sir, and see if we can pull out of that 72 how many are commercial.
We also had the MySpace, is that what the MySpace?
MySpace
That-
was in 2019.
Yes,
That was 2018.
2019.
Do you recall how many ERCs that was?
I think it was 12,
12, yes.
so it was a little over $100,000 worth of connection fees.
I won't be much longer, but just on page 10, we are recommending that financial policy guidelines be adhered to and looking at updating them for you. And not limited to this, but again, the minimum target of debt service coverage is 1.15 times, as that shows you. You're open above that, you'll be above that every year. I'd like to see personally a little bit more cushion than that. I don't want to see you go to the minimum, but that is VOA's minimum. That's their requirement, which really is very, very modest relative to industry standards. The second thing is we'd like to see, and we're way above this and continue though, at least 100 days cash on hand. As I said earlier, my personal recommendation would be to get to that 180 and be in that 180 versus 100 days. That's more like 3.3, 3.4 million. That's just me again. And so that's the second concept there. And then third is, as I indicated, we'd like to be in mode where we continue to work with Jonathan and monitor and stay on top of these things. And if indeed certain circumstances arise, then we can help you and just look together to be a step ahead, or at least an early warning sign. So, for example, those seemingly conservative connections go down to 10 or something, it's going to have a rightful approach to everything. And we want to be sure that we all understand. So, with that, just lastly on page 11, very briefly, here we are, winter 2020. Writing this update as a precursor to the 21 budget, and we're happy to come back sometime later this spring or summer, and hopefully maybe recommend some of these policies, especially after perhaps Mr. Whitley gets the budget sort of set for 2021, looking at all that. So again, I'm sorry about Kyle here, but he would love to have been here. He's been holed up at home for an entire week. Tomorrow we're hoping he's not going to work tomorrow. So that's really tough. Thank you. It's really wonderful to be back. Happy to answer questions.
Thank you. You have any questions?
I have a question. Mr. Wells, the line of credit here, it's easy to see. It's essentially a line of credit.
I'm sorry.
You have a line,
Yes,
a line of credit.
yes,
And we can pretty much tap that whenever we want. We don't have to apply for these basic hours. Why can't we treat that as cash on hand?
because again, it's borrowed monies, and so just
Well, but our cash on hand is also borrowed.
no, our cash on hand is not borrowed monies. Those are actual monies that have effectively have sort of flowed through the system. They're in excess of revenues, over expenditures, after paying debt service. Those are actually dollars that are not borrowed dollars. We don't mix the two of borrowed dollars versus actual cash on hand. So it would be actually local governments that do that, and you can jump in as well. You get in trouble when you start to think of cash on hand as being some borrowed money. So
Just real quickly, that is one of the first things Mr. Wheatley reached out to me and also talked to Kyle about last year, was to tie down that there really was in the $3 million plus of cash in the service authority, that to confirm that there really wasn't any consequential unspent bond proceeds sitting there, so that it really was available potentially to consider for cash flowing, to consider for all the ratios that Davenport wanted to use. So yeah, that's really just what's there is cash, and anything you draw down on the line of credit would be offset by the liability.
Right, I get that part. Well, on page 9, up in the left-hand corner of the page, where you have FY 2019 to 2024 capital funding, that isn't our borrowed money.
that is your borrowed money. Yes, sir.
Okay,
The debt is your borrowed money.
Okay,
Cash is actual cash flow.
but of that borrowed money, 3 million of that we borrowed
No. I'm not saying it well, sorry.
goes into cash.
No.
No.
Okay. So we have a line of credit for $15 million. We're planning to basically borrow, I'm gonna round off here, $11.5 million of that 15. We got the ability, if we needed to, if we didn't have the wherewithal of cash, meaning those dollars that we're talking about, let's say don't materialize, we could always go to that line of credit and make it, and use all of it.
We're hoping to cash fund $3 million of
Okay.
capital.
So of this capital funding that you're talking about, that 11.6 million is coming off our line of credit.
Yes, sir.
3 million is coming off our revenues.
Yes,
That's
exactly.
Okay.
You said a lot better than I could.
I don't think so, but yes, I get it now.
And
Thank you,
I
sir.
think that Mr. Lynch also coattails perfectly what Mr. Bennett was talking about earlier, that our expenditures, if you do a new facility, may go out beyond 15. So the idea that restructuring freed up some cash we could possibly put there also.
Any other questions?
I may have missed it, but, there's a plan of how we're paying this back. Is that what this chart is? Is it, well, I'm looking at, again,
Page 9.
9. I mean, we're gonna take out, the plan is to take out 11.6 million, right? But there's also in this chart how we're gonna be paying that.
Yes,
Is that-
so,
Okay,
so this is not, this table here, all the numbers, they're not meant, like, you see the new borrower, it's not meant to like be added, they're just a series of key points here, you know what I'm saying? So don't sort of go from 511,000, it's not meant to be that way when you look at this. You can't sort of tag it, it's not meant to be a
I guess
column.
what I'm just asking, just to
Yes.
clarify, when we start drawing that money out, it's set in the budget how we're paying it.
So what we've got, yes, so what we've got here is basically an accounting, if you would, of how to pay that back over what would be the next 4 to 5 years, because you see here, when we take that out in 25, 26, 27, see how the green gets a little bigger? That's because we've now turned out that roughly 11.5 million is now turned out permanently. And we use an estimate, for example, of 4%. So that's what we did. We used a 4% estimate of interest rate starting in 2025 to pay for that line of credit of roughly $11.5 million.
Okay, so you're down here, it's then, you're relying on an increase in user revenues.
Yes, we're relying on, and that's up through 2024, but yes, we're going to be then relying. I don't have in front of me what the next, let's say, 5 years are in terms of rate increases. We can get that for you. Again, that was in the model we gave to VRA. I just stopped right here. But that's factored in, yes. Does that make sense? We just stop right here graphically, but we can go get you what the rate increases, which you have not approved yet, but inevitably would from 25 out to 29 and beyond. And the reason for that is because, again, there's so many variables between now and the next 5 years. It just doesn't really make much sense to overload.
And I guess, like, when I'm looking under 2020, that increase in user revenues 10%, that was the big.
That was the thing we talked about.
That's what
Yeah.
started
That other
July
10%,
1.
sorry.
Yes, ma'am. Yes,
That's
ma'am.
what got the shit right.
And then the rest should only be 4%.
That's
4% for 3 years, and then 3% for last year.
Yeah, so that's fine. So there's no, let me make it clear, if you continue on this general path, and I was listening, I think I heard you talk about maybe expenditures go up more than is estimated, materially more than estimated, and let's say residential connections, equivalent residential connections don't happen at 50 or what have you, then we'll find out what user rates will have to be, meaning, you know, in year 2025, 2026. But the way it's set, if you kind of keep within the trajectory of what the planning was for this past year that Kyle and I and Griffin worked on with staff, we're not going to see a big spike again in 2025. Let me be clear again, if we don't have any special surprises, it's not as if all of a sudden in 2025 we should see a 20% jump. However, if expenditures grow considerably higher, if connections don't grow so well, then but you'll know that year to year. If we continue to monitor and give you this kind of report, and let us do that every year, then it's going to minimize the chances that you don't get surprised. Because this is, think of this as a rolling 5-year, 4 or 5 year information. Does that make sense?
It's part of writing the ship too,
Yes.
to be on sound financial.
That's
track.
right, that's right.
And a lot of it was to get cash up front to do the things that
Have to do.
Q's hammered us. And we've done some of that and made plans to do others.
Question, in your modeling, okay,
if we're combining what we're doing here, right? It looks like year over year we're getting more connections, but people are actually using less water and sewer. If I'm reading it correctly, because it's saying that our revenues aren't increasing.
Which page are you on the audit report?
The 5.
Page 5.
But because the last note says the authority's operating revenues were increased by $176,555 compared to prior year. This was mainly due to increase in availability fee and debt fee revenues. So basically the restructuring fixed that. And then it said, but it was offset by the decreases in water and sewer sales revenues. So we added 50 connections, but we made less money on those connections. So
We've seen that a lot because of, people are doing conservation and things like that, more efficient, toilets and all of those things. So that's part of, that's another variable that will be important year to year. So if we continue, and the other variables are, again, it's going to be the wet years and the dry years, that all plays into the year to year. But you have to do some element of averaging, so we look to, that's not numbers that we create. What happens is we correct the job. That's why you also have a utility consultant with the same folks that, let's say, help you know that you need to do this, this, and this in terms of the consultant engineers. Also sometimes will help your staff with some recommendations as to how to look at, let's say, unit pricing or unit usage, consumption and things like that. That's not my role. I just take.
I was just wondering if it had been like average the model where you look back and you see the decrease over the last 10 years.
Go to page 72, sir, of your audit. And it's separated into 2 columns. You get the accrual of the years that you're talking about, sir, but it's also broken down between the water system and the sewer system. You can see any trends when it comes to daily average consumption, gallons of water, and the same for the sewer.
Okay.
And then also, just not to the question you just asked, but an interesting, if you'd like to dive into the detail, the following page 73 will show you our large users of each of those systems. It kind of gives you a feel of who are our customers, who are our large users. But 72 gives you that breakdown sort by year. Okay.
Thank you.
Thank you, I appreciate it. No more questions?
Thank you, Mr. Rose, and I apologize for that gas there.
No, it's all right.
Thankfully you came, thank you.
Thanks so much. All right, be well.
Our next steps?
So the next step is just a placeholder, remind myself to ask the board for some following workshop dates for our next budget session. And I'm just going to throw some dates out there. Please look at your calendar. You are the board. You tell me what works. These dates are all Thursdays, I believe. So I'm looking at February 27th, March 5th, and March 12th.
Do we do them one at a time, or how do you want to do it?
No, I know you're not going to be here.
I'm okay for all 3 of them.
Okay.
March 12th, I'll be out of state.
What's that, sir?
March 12th, I'll be out of state. The other 2 days are okay.
How about we do February 27th to March 5th? Everybody?
Okay, and then we'll forecast on the 5th, our next, if we need a session.
Yeah, is everybody okay with
I think Ms. Cup
Well,
was.
what's the date?
27th, is there any, just that date? I couldn't be here until 6:30. I can't do 6 o'clock on
Okay.
27th. That
At
would
the-
be a hardship.
But 6:30, you said you could?
6:30 would work, yes.
So if it's okay with the board, a 6:30 shouldn't affect, because we can, the way I look at it is Wilma and her team has condensed the budget down to 2 department functions. So before where we had 4, so
And that's something we asked you last.
that's something the board of directors did direct us to do. So we'll bring those out and we got to cut it off at a certain time, fine, we can cover water first, and we can move into sewer. So 6:30 will still get us out, 2 hours or less, it's probably enough for anybody. I think I told Griffin when I was on the phone earlier, I got the movie rule, if it goes over 2 hours, you lose me. But that's up to the board, so 6:30 start time, if it's amenable to the board, that works out fine.
So on the 27th, 6:30, okay? And then on March 5th, go back to 6?
Yeah.
Or do you want to do 6:30?
Well,
Is that better for you?
well,
Or the conflict?
got a meeting at, like, we had the last week.
Oh, okay.
And I try to set these too. I know Mr. Bennett he has a period of time, I believe starting in March through April, that he will be unavailable. So I'm trying to get us enough time where if you feel comfortable by that, I know we're talking about 2 meetings, but by that 3rd meeting, then that'll affect when we advertise. I'm projecting right now that hopefully somewhere late March, April, you all feel comfortable with the budget. We'll go to advertising, have your public hearing, and then, following meeting, we'll look to adopt, approve.
How about March 4th? I mean, I know it's the day before. Everybody else do March 4th?
March 4th and Lewis 5th,
Yes.
that's fine too.
Right, so March 4th?
March 4th, okay,
at
What
6
time?
o'clock. 6
6
o'clock?
o'clock?
Okay. And you'll send out an invite for?
Yes, ma'am. Yes,
Thank you.
ma'am. And I think it'd be okay to be determined on location. We can set that up as long as we have the date.
So we're good?
I just want to give a quick thing. I meant to cover on Davenport. So we did receive notification from Virginia Resource Authority. They were just concerned because our debt service dropped. I met with them on Monday, along with Davenport. Kyle was actually on the phone. Flew or no flu, he's there. It was a very productive meeting because what we walked through was, we feel, was a timing. The expenditures, as you saw here, that were high, that was already during the closeout before we were able to take advantage of the summer pool loan. So it was a timing thing. You had expenditures, then you had your restructuring, then you had your rate increase. So that favorability will come back. All they've asked for, and Davenport's going to supply at the end of this month, is basically a summary, a narrative showing that, and probably have one of these charts that you saw that shows where that debt service coverage is. They did let us know that they have a new policy. It'll affect FY20 moving forward. So if you drop below that, they have a $5,000 penalty. So we don't feel like we'll be in the penalty range. I just want to inform the board and our citizen members that I had that meeting because we were discussing the purpose of that. Kyle and them was to recalibrate this model and say, are we going to get there? They have our cash flow reports, they have our current revenue expenditure summaries, so we appear to be in great shape. Just wanted to let you know that there was just a timing issue when the financing occurred in our budget. So Madam Chair, that's all I had for the night.
Thank you. Do I have a?
And I didn't have the date, but that adjournment will be until the 18th.
Did you say the 18th or 5?
Yes.
Correct. I move to adjourn the Board of Directors of the King George County Service Authority to Tuesday, February 18th, 5:30 p.m.
Second. Any discussion? All those in favor?
Aye.
Any nay? No. Chair votes aye. We are adjourned.